You've heard the myth 1,000 times. To buy a house, you need 20% down $100,000 on a $500,000 home, or forget about it. It's the story that stops millions from even starting the process. But in 2026, that's straight up outdated advice. The reality first-time buyers are putting down an average of just 9 to 10%, according to the latest NAR data. That's only $36,000 on a $400,000 median home. And for many, it's even less, 3.5% with FHA loans, 3% on conventional, or straight 0% with VA or USDA programs if you qualify. With mortgage rates holding at 6.11% as of Freddie Mac's February 5th report, and national median home values around $359,000 per Zillow's January index, low-down options are more accessible than ever. But here's the twist. The more down payment is always better myth can actually cost you big time. That extra cash tied up in your home could be growing elsewhere, like in the stock market, at 7% historical returns, potentially turning $60,000 into $120,000, plus over 10 years through compounding. This video dives into the 2026 down payment reality. How much do you really need? We'll bust the myths with cold math, compare low versus high down scenarios, and give you a framework to decide what's right for you without the hype. If you're a finance beginner eyeing a home in the next 12 to 24 months, this could save you from regret or missed opportunities. Stick around to the end and drop your rough numbers in the comments. What's your target home price, credit score range, down payment percentage you're aiming for? I'll reply with quick breakdowns. Stick around to the end and drop your rough numbers in the comments. What's your target home price? Credit score range, down payment percentage you're aiming for? I'll reply with quick breakdowns. Let's start by busting the biggest myth head on. Myth number 1. You must put 20% down to buy a house and avoid PMI. That was true in the 1990s. In 2026, it's completely outdated. Here are the actual minimum down payment programs available right now. Conventional loans, Fannie Mae and Freddie Mac, as low as 3% for first-time buyers through Home Ready or Home Possible programs. FHA loans, 3.5% if your credit score is 580 or higher, 10% if 500 to 579. VA loans, 0% down for veterans, active duty military, and eligible spouses. USDA loans, 0% down for homes in eligible rural and suburban areas. So on a $400,000 home close to the national median of $359,000, you're looking at 20% down equals $80,000, 5% down equals $20,000, 3% down equals $12,000, 5% down equals $14,000, 0% down equals $0 if you qualify for VA or USDA. The real-world average for first-time buyers in 2025 to 2026 is only 9 to 10% according to the National Association of Realtors. That's just $32,000 to $36,000 on a $400,000 home, not the $80,000 to $100,000 everyone thinks they need. Rates are still sitting at 6.11%. Freddie Mac, February 5th, 2026. Higher rates mean higher monthly payments, so the lower your down payment, the easier it is to qualify on paper. But there's a catch. If you put down less than 20%, you'll pay PMI, private mortgage insurance. On a $380,000 loan at 5% down PMI, typically runs $100 to $300 per month depending on credit and loan type. That's real money leaving your pocket every month until you reach 20% equity or refinance. Add closing costs, 2 to 5% equals $8,000 to $20,000, plus 3 to 6 months of reserves in the bank, and suddenly low down starts to feel expensive again. So the question isn't, can I scrape together 20%? The real question is, what down payment amount actually makes sense for my situation in 2026? With the myths cleared out of the way, let's now run the cold full stack math and see exactly how much each down payment option really costs you and what it could cost you in lost opportunity if you oversave for a bigger down payment. So the myths are cleared, but numbers don't lie. Let's run the full cold math on a realistic 2026 example of $400,000 home close to the national median of $359,000, but typical for a decent suburban 3-bed / 2-bath with good schools. We'll compare 3 scenarios: 20% down, $80,000. Cash traditional safe amount, 5% down, $20,000. K common conventional / FF. HA path 0% down, $0 cash, VA or USDA if eligible. Loan amounts 20% down to $320,000 loan, 5% down to $380,000. Loan 0% down to $400,000 loan at 6.11% 30-year fixed. Freddie Mac current rate, principal and interest only $320,000 loan to $1,940 per month, $380,000 loan to $2,300 per month, $400,000 loan to $2,420 per month. Now layer in the full PATI plus extras. Property taxes 1% average effective rate to $4,000 per year, $333 per month. Homeowners. Insurance $200 per year average, $175 per month. Maintenance / repairs 1% rule to $4,000 per year, $333 per month average PMY. If less than 20% down 0.5 to 1. 5% of loan amount annually, 5% down $380,000 loan to PMI. $150 to $250 per month, 0% down to PMI. $160 to $300 per month, or none for VA / USDA total. Estimated all-in monthly ownership cost 20% down $200 to $400 per month. No PMI 5% down, $600 to $800 plus per month. With PMI 0% down, $700 to $900 plus per month with PMI, unless VA / USDA. That's a $400 to $700 monthly difference just from the down payment choice. But the real killer is the opportunity cost of putting more money down. Take the $60,000 difference between 20% down $80,000 and 5% down $20,000. If you only put 5% down and invest that extra $60,000 in a broad index fund at a historical 7% annual return, S&P 500 average after inflation, after 5 years to $50,000 to $52,000 growth, after 10 years to $118,000 to $125,000 plus compounded. That's money growing while your house equity builds slower, higher interest paid on larger loan. The cash in the house is illiquid, you can't easily access it without selling or refinancing, so you miss out on market returns. Tee this back to rent versus buy. If comparable rent is $2,400 per month, Zillow average 3-bed. The monthly gap with low down is $1,200 to $1,500. Invest both the $60,000 extra down payment and the monthly savings leads to over 10 years. You could easily outpace the equity build from a higher down scenario. Especially in flat or modest appreciation markets, Zillow forecasts 1.9 to 4% for 2026. Hidden killers with low down PMI adds $100 to $300 per month until you hit 20% equity could take 5 to 10 years. You pay more total interest over the loan life, larger principal. House poor risk. Stretching budget to qualify with low down leaves, no buffer for repairs rate changes or life events. The math shows bigger down payment equals faster equity plus no PM plus lower monthly stress, but smaller down payment equals more cash working for you elsewhere, plus earlier home ownership, plus potential to beat equity growth through investing. It's not black and white. The best choice depends on your timeline, risk tolerance, and market. With these numbers clear, let's look at when low/no down actually wins and when 20% is still the smarter play. With these numbers clear, the big question becomes, when does putting less or even zero down actually win in 2026? And when is the traditional 20% down still the smarter, safer choice? Low down payment, 5%, 3%, or 0% wins in these situations. Short timeline, 5 to 7 years. Opportunity cost of tying up extra cash in. The house is high. If you sell soon, appreciation may not cover closing costs, selling fees, and PM. I paid investing the larger down payment elsewhere often beats equity growth. Rapid income growth. If your salary or side income jumps quickly, you can easily cover the higher monthly payment and PMI until you refi or build equity. Eligible for VA or USDA, true 0% down with no PMI. One of the best deals in 2026 if you qualify. Flat or low appreciation market when home prices grow slowly. Zillow forecasts 1.9 to 4%. Nationally, investing the saved down payment at 7% historical returns can outperform home equity build. On the other hand, 20% down is still better when long hold 10 plus years. You avoid PMI entirely, get lower monthly payments, and build equity faster through principal paydown. Over a decade, the interest savings and equity growth often outweigh opportunity cost. Risk-averse mindset, no PM. I stress bigger buffer against repairs or market dips. Peace of mind, knowing your payment is lower and more predictable. Strong appreciation market. In areas with 4 to 6% plus annual growth, equity can compound faster than stock market returns, making the larger down payment pay off big. It's not low down is always better, or 20% is the only safe way. It comes down to your personal fit, timeline, income trajectory, eligibility, risk tolerance, and local market conditions. There's no one size fits all, but now you have the math to see which side tips the scale for you. Let's pull it all together into a simple decision framework you can apply right now. There's no one size fits all, but now you have the math to see which side tips the scale for you. Let's pull it all together into a simple decision framework you can apply right now. Step 1. Check your eligibility. What's your credit score? Do you qualify for VA, USDA, or first-time buyer programs like Home Ready? Run your numbers through a lender pre-approval tool. This decides whether 0%, 3%, or 3.5% down is even possible. Step 2. Calculate the full monthly cost for each down payment scenario. Use an online mortgage calculator and add property taxes, insurance, PMI if under 20%, HOA, utilities, and maintenance 1% rule. Get real quotes from local insurers and tax assessors. Step 3. Compare that monthly total to rent for a truly comparable home, same size, location, schools. If the ownership cost is only $300 to $500 higher, low down might still make sense. Step 4. Project the opportunity cost. Take the difference in down payment, for example, $60,000 between 20% and 5%, and run it through a compound interest calculator at 7% annual return. See how much you'd have after 5 and 10 years if you invested it instead. Step 5. Evaluate your personal situation. How long do you plan to stay? Are you comfortable with PMI and higher monthly payments? Do you have a full 6 to 12-month emergency fund? What's your risk tolerance for market dips or repairs? This framework shifts your mindset from how much do I need to scrape together to Which option actually fits my life in 2026? It's not about the more down the better, it's about the amount that gives you the best balance of flexibility, peace of mind, and long-term wealth. Here's the bottom line for 2026. The 20% down payment myth is officially busted. You don't need $80,000 or $100,000 to buy a house. Many people are buying with 0 to 5% down right now. But low down options come with real opportunity cost and PMI that can add up fast. Run your own numbers before you decide. Use FHAVA or USDA if you qualify, but always calculate the full picture first: monthly costs, opportunity cost, and your personal timeline. If this video helped clear up the confusion, drop your rough numbers in the comments right now. Target home price, credit score range, down payment percent you're thinking. Location, I'll reply with quick breakdowns whenever I can. Hit subscribe and the bell for more 2026 real estate math and beginner-friendly guides. Share this with anyone who's stressed about saving for a down payment. It might save them months of worry. Thanks so much for watching. Choose smart, stay flexible, and I'll see you in the next one.